Okay, thank you very much. We're going to start the second half of the investment finance session. The session is called Information and Asset Pricing. We have two more papers left. The first paper is going to be presented by Chen, Attention Spillover in Asset Pricing. The discussant will be Zhenyu from CUHK. Okay, Chen is from Southwestern University of Finance and Economics. Go ahead, Xin, you have 20 minutes.
Okay, can you hear me and see my slides?
Yeah, it's great. There are some boxes, but I think just go ahead.
Okay, thanks. Good morning, everyone. I'm Chen from SUFE. Thanks for this opportunity to present our paper. Our paper is Attention Spillover in Asset Pricing, co-authored with Zhenyu, and Jianfeng. Our research motivates from two investor behaviors. The first effect is positive feedback trading. In this theory, researchers found that investors tend to trade more after positive trading experience, and it may be explained by self-attribution bias, that investors tend to attribute success to their own trading ability and become overconfident and then want to overtrade stocks. Another effect is limited attention. This theory says that each investor has a limited resource of attention. He could only focus on a small group of stocks. Combining these two effects together, we obtain a new effect, the attention spillover effect. Let me explain this effect through the following picture. The larger circle denotes the stocks that are noticed by an investor, and the smaller circle denotes the stocks that the investor currently held. If the stock in the portfolio or currently held in the portfolio has a good performance, the investor becomes overconfident and want to overtrade want to trade more the stocks get noticed. So we call this effect as attention spillover. That is, after a positive trading experience, an investor tends to purchase stocks that have caught his or her attention. Applying this trading behavior into the market, we can find an implication in asset pricing, that stocks that are noticed by investors who are winning investors will face a higher buying pressure and thus become overvalued. How to test this effect? Our main hurdle is to identify the stocks that are noticed by winning investors. We solve this problem through a display setting in trading software in China. In China, trading software lists stocks according to the stock listing code. So if an investor is focusing on a certain stock, he has a large chance to notice other stocks with adjacent listing codes. Here is an example. If an investor is focusing on Guizhou Maotai, he can search the stock by typing GZMT on the computer and press Enter button. Then he will jump into the main page of Guizhou Maotai. Guizhou Maotai has a listing code of 60519. If the investor further press the page up button, he will jump into another stock's main page, which listing code is just before the Guizhou Maotai's code. Also, if he press the page down button, he will a new stock's main page appears, which listing code is just behind the Guizhou Maotai's code. Also, if we press the Enter button once more on the computer, a screening page appears and shows the stocks in order of listing code. What's more, if we search the stock by its digit numbers, after typing first 5 digit numbers, a drop-down window appears and also shows the stock with adjacent listing code. So based on this display settings, an investor can notice when an investor is focusing on a certain stock, he can notice other stocks with adjacent listing codes. We apply this display settings to test the attention spillover effect in asset pricing. Let's focus on this picture. Let's focus on the focal stock, which listing code is 60521. The stocks with adjacent listing codes will be displayed together with this stock on the screen. If the adjacent listing codes, if the adjacent stocks have good performance, their investors become overconfident and want to trade stocks they noticed. Due to the display settings, this focal stock has a large chance to be noticed by these investors. So this stock will face a high purchasing pressure and then get overvalued. So we imply that both focal stocks return and turnover can be predicted by past performance of adjacent stocks. In order to test this implication, we construct a local variable to measure the performance of adjacent stocks. Our local variable is calculated as the value-weighted return of adjacent 10 stocks in past 2 weeks. And also we control the short-term reversal effect to derive the local variable. We also want to stress that our local variable has little relation with stocks fundamentals. Since the stocks with adjacent listing codes have little fundamental relation. Here is a assignment rule of listing codes in China. In China, each stock has a unique listing code, consists of 6-digit numbers. The first 3-digit numbers denotes the listing board, and the next 3-digit numbers are assigned mainly based on stock's listing date. We plot the relation between stock listing codes and listing dates in each board in this figure. We can say that the stock with an earlier listing date will be assigned with a smaller listing code. So based on this assignment rule, we suggest that stocks with adjacent listing codes have little fundamental relations. In China, there are a lengthy administrative approval-based IPO process. So firms typically apply for IPO as soon as they meet the requirements. So if 2 firms go public on the same day, it's just happening for them to get listed on the market together. So they have little fundamental relations. And so we think our local variable is a pure behavior variable, which has little relation with fundamentals. And also, since the local variable is related with listing date, we will control the age effect in our test. Our paper is related with 2 literatures. The first one is the attention-induced price impact. In this literature, researchers have found many attention-related variables could forecast stock return. However, we can see many of these variables are related with stock fundamentals. So there's still a concern that whether the predictability comes from the attention-induced impact or just the fundamental relations. However, our local variables still find similar results, but our variable is much more clean. And also, our research combines the literature on attention and the literature on positive feedback trading. We find the implication of the interaction effect of these 2 behaviors. Here is our main result. We show that our local variable actually predicts stock return by using one-way sort method and also the Farmac best test. After controlling a wide range of characteristics, our local variable could positively predict stock return in the next week. And also, we find that our local variable positively predict the stock's turnover in the next week. And the way suggest the predictability comes from the attention spillover effect, which is the interaction effect between attention and positive feedback trading. So in the following slides, we will provide evidence on attention and positive feedback trading. In this slide, we show that we compare the correlation among nearby stocks with the correlation among far away stocks. We find that as in the first figure, S1 denotes the return correlation between the focal stock and its nearest 10 stocks, and S2 denotes the return correlation between the focal stock and its next nearest 10 stocks, and so on. I can see from this picture that as the distance between stocks increases, their return correlation decreases, and also the difference between S1 and S5 is positively significant. This means that if two stocks displayed together on the screen, they are more likely to be noticed by investors, so they will have a higher co-movement. And also we find similar pattern on turnover correlation. Where this pattern comes from fundamental reasons, we check the so in order to rule out this explanation, we check the distance and the correlation in fundamental variables. We find there are no discernible patterns between distance and correlation in fundamental variables. And this also means that our local variable has little relation with stock fundamentals. And also we sharpen our empirical test by using a quasi natural experiment. In 2004, China government introduced SME board. Before 2004, the stocks in Shenzhen main board are displayed together with stocks in Shanghai main board. So after 2004, the introduction of SME board separate the Shenzhen stocks in Shenzhen and the stocks in Shanghai apart. So we check whether whether the correlation will decrease if the stock distance increases. Here is some definition. 000Z and 000Y denotes the last and the second last 20 stocks in Shenzhen main board, and the 600A and the 600B denotes the first and the second first 20 stocks in Shanghai main board. We focus on the correlation between 000Z and 600A, and we find that if we compared with the correlation between 000Y and 000Z, this correlation will decrease after these two kinds of stocks get separated. And also, if we compare them, this correlation with the correlation between 600A and 600B, this correlation also decreases after the stocks get separated. And we find similar evidence on turnover. Yeah. Also, we provide evidence on attention channel and a positive feedback channel by implying placebo test. In panel A, we construct a placebo variable as the performance of faraway stocks and find this variable could not predict stock return. It means that if the stocks far away have a good performance, their investors become overconfident and want to overtrade stocks. However, they could not notice the focal stock, so they won't purchase the stock. So this evidence supports the importance of attention effect in our effect. And also in the panel B and panel C, we construct two other placebo variables by implying the turnover or the return volatility of adjacent stocks. It means that if the adjacent stocks have a high turnover or has a volatile return, they attract the investors' attention. However, the investor haven't become overconfident, so they won't overpurchase the focal stock. So this evidence suggests the positive feedback channel. Also we provide evidence to show that our strategy, excess return of our strategy, comes from investors' irrational trading behavior. We show that our strategy will produce a high return in the short run. However, this return will vanish in the long run, and also our strategy will be stronger in stocks with a higher arbitrage cost, and also will be stronger in pairs with higher sentiment, in pairs with higher sentiment. And lastly, in the previous test, we showed evidence through the market reaction, and lastly, we will provide evidence from investor trading behavior. We imply investor trading data, which consists of 0.4 million investors trading close from 2009 to 2012, and we compute several probabilities to show that, to support the attention effect, the positive feedback effect, and also the attention spillover effect. In the first figure, we compute the probability of purchasing a new stock when the investor is in winning status or is in losing status. We can say that if an investor earns some money, he will have a high probability to purchase a new stock. This evidence supports the positive feedback trading effect. And also in the second picture, we show the probability of purchasing a nearby stock. The x-axis is the distance between the newly purchased stock and with the stock currently here, with the stock in the portfolio. And we can say if an investor decides to purchase a new stock, he has a large chance to purchase the stock which is displayed next to the stock in the portfolio. This evidence is in line with the attention effect. Combining these two effects, we will obtain the attention spillover effect, and the green line, which is shown in the third picture, and in the red line is the probability of purchasing a nearby stock when the investor is in winning status, and the green line is the probability when the investor is in losing status. And we also compute the difference between these two lines and plot the result in the fourth picture. We can say that an investor actually more likely to purchase the stock which is displayed nearby his position stock, and the fact is stronger.
So you only have 2 minutes left, so you need to speed up and finish up.
Okay, thanks. Okay. And so the effect is stronger if the investor has just earned the money. So this is the evidence to support the attention spillover effect. And also we find that attention spillover effect is more stronger when the positive experience is more recent. Okay, here is our conclusion. In our paper, we find a new effect, the attention spillover effect, which comes from the combination of attention channel and the positive feedback channel. And we also find a strategy that both stock return and the turnover could be predicted by the performance of adjacent stocks. Our paper provides evidence on the combination and the interaction effect between attention and positive feedback trading. And also our paper provides a novel identification evidence for attention-induced price impact. That's all our paper. Thanks for your listening and hope for the discussion.
Thanks very much, Sin. The discussant is Zhenyu from Chinese University of Hong Kong. So you have 15 minutes. Go ahead.
Thanks very much for inviting me to discuss this very interesting paper. Let me quickly summarize the finding of this paper. So this paper aims to study the joint impact of overconfidence due to this kind of a positive feedback effect and attention spillover on stock prices and turnover. Okay, I think their identification strategy is very smart. Okay, they find that actually the trading platforms in China display stocks based on the order of the listing codes. Okay, and they argue that this kind of order is arguably exogenous, right? It's irrelevant with many stock characteristics, including the size and other things, right? So basically, it's kind of like exogenous, right? Order, okay. And later they actually introduce a quasi natural experiment. They actually started an event in which actually the SME board, the small and the medium enterprise board, was introduced. And it was actually, the display was inserted between the Shanghai and the Shenzhen main boards. So the final, the end, the stocks in the Shanghai board, the last stocks in the Shanghai board and the beginning stocks in the Shenzhen board actually were suddenly separated. Okay, so the distance was increased. Okay, so I think this is quite smart. Okay, so their main findings if the stock, they have some labels, but the labels recently in the past 2 weeks, they have higher returns. Then those stocks tend to have higher returns in next week, in the following week, also turnover. Okay, and they also find that actually this pattern reverses later. Okay, and they actually also look at the co-movement. They find stronger co-movement of adjacent stocks than that of the distant stocks. Okay, it's quite related. Finally, they have amazing account level data from a retail brokerage firm. Okay, they actually find that investors tend to buy laboring stocks if they have the winning experiences, kind of a microfund their return and the turnover results. That's pretty good. Yeah, I really like the identification strategy. Also, I think the findings are all sensible. Okay, and my comments have following 4 aspects. Okay, so first of all, I want to understand more about the mechanism of the paper. Okay, then I'll talk a little bit about the trading behavior related to their account level trading and holding data. Also, I want to talk a little bit about another alternative, just one alternative about the mistakes. Okay, then I'll go to the pattern of the spillover. Okay, so my main focus is actually about the mechanism, right? There are 2 driving mechanisms here, right? One is overconfidence because of the positive feedback, right? People experience the high return, they become more confident. Okay. The other one is so-called attention spillover. Okay. Due to limited attention, actually they pay attention to a limited list of stocks. They argue that it's those laboring stocks because they are all more easily to be observed. Okay, so they actually do the placebo test to shut down each channel separately, which is really good. They look at distant stocks, right, rather than laboring stocks. They find 9 results. also they replace the returns, right? So the neighboring stocks with high returns, then the stocks itself, the focal stock, will have high return later. But if they actually construct sort the labor stock based on turnover or volatility, they find none results. Okay, so this is basically related to returns. Okay, that returns. That's pretty good. Okay, but I keep actually thinking two questions when we actually read the paper. Yeah, first question is, why does this attention spill over? Right? Why attention gets spilled over? So the second question is, what kind of attention spills over? So I'll illustrate my ideas following. So first of all, why does attention spill over? If those guys are overconfident, if they actually observe a high returns in their in the focal stock, why not just buy more shares of their stock? Why do those investors want to trade other stocks? Right. I think that's the first question you may want to answer. Okay. So actually, relatedly, so actually, because you are talking about spillover, right? So people may be curious about the comparison between the direct effect and the spillover effect, right? So I just talked about they may directly buy the stocks they are holding, right? This is a direct effect, and then the attention spillover, they buy other stocks, right? That's a spillover effect. Could you do the comparison quantitatively, right? I think that probably you need to do that. But I understand it's actually tricky because there's a lot of endogeneity right here, because you look at the return, and there's a so-called reflection problem there. But is it possible actually to look at some exogenous shock to the focal stock, then look at the response of the return in the focal stock and the labor stock, and do the comparison? I think this is important to know, right? I actually think about this kind of attention spillover from a different angle. I think probably there's some force actually containing their trading in the focal stock, right? So one possible hypothesis is about the daily price limits in China. Okay, so China actually has this kind of a 10% daily price limit, right? The stock movement cannot go beyond 10% up or down. But so I have a paper, also a series of papers, document if the stock hits the limit, especially the upper limit. This is a attention grabbing event. Okay, people want to jump in to buy the stock. Okay, however, right, they actually kind of couldn't do that on that day, right? But they think that the stock can still increase, the stock price can still increase. Just because of this price limit, the stock cannot continue to increase. So they actually tend to buy the stock next day, right? Especially for those small retail investors. Okay, but it's also possible, right? If they couldn't buy this focal stock, they just trade the so-called related stock. Okay, in their mind, right? Probably they just trade the adjacent stocks, right? Right. It's just on the screen, and they just buy those stocks. Okay, and if this is right, this price limit thing is important, then I think it's also related to your finding, right? Because it's upper price limit, 10%. Of course, is a big increase, right? So is it possible that this price limits facilitates this kind of a spillover? Okay, so I think you may want to actually test it. Okay, so the second question is, what kind of attention spills over? Okay, so there's a lot of attention grabbing events, right? So you actually focus on the return. Okay, and you also look at the volatility and turnover, the trading volume. There are also attention grabbing events, which are good, but there are also many others like advertisement, news, those kind of things, right? So you find that the results from returns rather than the turnover and the volatility. Okay, but this kind of attention. So in that sense, attention related to turnover or volatility could not get spillover. Okay. But I'm still wondering, right? So why is that? And also for this like returns, right? It could also related to other attention grabbing events like news, like earnings surprise, right? Right. So if you have positive news, you have positive earnings surprise, right? They are attention grabbing, okay? So but they also trigger the return to increase. But it's not necessary. It's just because of the observation of high return, right? It's possible. It's just due to the news itself, right? And they can get spillover. Okay, so I think it's actually interesting to look at to look at this question, right? Because you are talking about the general attention spillover, but actually you just find that attention return related attention gets spillover. Okay, so
4 minutes more.
Right, sure. So I'll talk about trading. Okay, this is amazing data, and their exercises is pretty good. And their exercise is based on at the level of investor and stock level. Okay, so if like the one of stock held by the investor experience a high return, right? They find that actually the investor tend to buy more stocks. Okay, this is pretty good. But I keep wondering, right? So because you argue this is an overconfidence story, I keep wondering what this overconfidence actually stems from this single stock or the portfolio, okay, or their whole holding, okay. So and would this contribution of the winning stock to the whole portfolio matter? Yeah, that's my question. I think like you may at least look at the winning experience from the whole portfolio, because if you want to push the overconfidence story, or it's just about like a price extrapolation or the positive price impact, right? So I think you may want to explore more on that. Okay. Also, you can use the trading data to explore the mechanism I mentioned before about, right? Like look at the price limit, like spillover. Because trading data actually can exactly tell us what's the behavior of those retail investors. Okay. I have two more comments. One is about mistake, right? So is it possible the investor trade adjacent stocks just by mistake? Okay. There are two possible mistakes, right? One mistake is like they just click the neighboring stock, right, by mistake, or they actually get confused by the listing codes, right? So some listing codes like look similar to the focal stock, then just click them. Okay. So actually, the paper talk a little bit about this. They argue that no results of turnover prediction for returns address this concern. But I think the most straightforward test is related to this: is whether this kind of focal stock turnover can predict, right? The neighboring stocks turnover can predict the focal stock turnover if it's like a mistake. But I still don't think it's fully addressed this question. So it may be helpful to look at whether the effect is much stronger for stocks right less to the focal because of your wrong click. Or if you can find that, so for example, this is a multi, right? This is listing code of multi. And if you actually find that, right, for the left-hand side, right, 1718, this is just one digit difference, right? But the right-hand side, right, so 2021, they have 2 digits difference. So maybe actually this effect is stronger on the left-hand side. Also, you can look at it a little bit further, right? 600529. Now, still 1 digit difference, whether you have effect there, right? actually mitigate the concern. And finally, it's about the patterns of spillover. I think the authors already look at something like a 10 stock, 20 stock, and 40 stock. Actually, I still want to explore more about the range, and especially one thing I don't think they have done is about the speed of the spillover. Okay, why you look at 2 weeks for the window of the past return and 1 window for the future return? Okay, could this spillover last for a longer time? Okay, and maybe it's interesting to capture the spillover dynamics to look at some lead lag effect over the distance of the focal stock. Okay, so overall, I really like this paper. Really enjoyed the paper. I just want you see more studies on the mechanism. Right. Best of luck. Thank you very much.
Thank you, Zhenyu, for the discussion. Maybe Chen or co-authors would like to respond.
Thanks, Roger. So let me take the first stab at responding to Zhenyu and take all the questions. And Zhenyu, if you have additional thoughts, feel free to add. And first of all, thank you very much, Zhenyu, for this insightful and constructive comment. So I think you asked several very big questions, and let me try to say something on that. So first, so you asked the question, why does the attention spill over? So let me try to further clarify what is these the attention spillover mechanism we have in mind. So our mechanism actually is a joint force of 2 effects. One is the limit attention effect, and the other is the positive trading effect. So if you think about the positive trading effect, which goes back to Jervis and Odine's 2001 paper, and the mechanism that they talk about in their theory paper is that when investors experience positive performance, they become overconfident of their overall ability, and they tend to trade more of all the stocks, or they tend to increase their risk exposure. So if this is the specific mechanism in mind, they do not necessarily focus on the stocks that they currently hold, but they are also likely to buy stocks that have caught their attention. So that's how we think about the positive feedback channel that we derive our hypothesis. And secondly, this is also related to the first question. So you ask the question, what kind of attention would spill over? And I think you are speaking directly to one of our placebo tests. So let me first clarify the placebo test and how we design it. So in that test, we try to shut down the attention effect and the positive feedback effect one by one and see whether the joint force of the two are the important thing that underlies our return pattern. And when we try to shut down the positive feedback channel, we actually replace the return of adjacent stocks by the turnover of the adjacent stock. So the turnover are likely to capture the attention grabbing effect. However, a key ingredient missing in this construction of placebo test is that the investor not necessarily just had a positive experience. Or put differently, the positive feedback channel is actually missing when we construct the placebo variable in this way. Therefore, we wouldn't expect there is return predictability from the local stocks turnover to the focal stocks future return. So this is what we have in mind. It's not saying the turnover and volatility are not attracting attention, but the other key ingredient is missing here. But I think the general point you make is very well taken. And this is actually what we are currently doing by revising the paper. We are trying to, I think your general point is saying, why do you focus on returns, right? There are so many attention-grabbing events and so many attention-grabbing signals. And this is exactly what we are doing. We try to look at other very salient events and salient attention signals and try to understand how the general theme of attention spillover contribute to the return pattern. And also you mentioned daily price limit as one potential salient attention grabbing event we can put more focus on. I totally agree. I think this is a very good suggestion. So on one hand, it's very salient and potentially attention grabbing. And also, as you mentioned, it's actually introduced an inability to trade the focal stock for the investors. Therefore, the attention spillover might become stronger. I think you also have several other specific suggestions for implementation, and these are all very well taken. Thanks again for the constructive comments.
Hey, thanks, Lian. Any questions from the audience, from the panelists or attendees? Otherwise, Zhenyu, you want to respond to what she said?
I think I appreciate your response. That's it.
Okay.
Yeah. I look forward to your next version.
Thank you.
Thank you.
So, Lian, I have a question. So, for this ticker numbers, I mean, how are they determined? And that's number one. And number two, can the person searching for the ticker sort in any other fashion besides by number? Because if they don't choose this sort method, they sort by some other thing like, I don't know, industry or by something else, then the sequence that they see could be different, right?
Sure. I think this is a great question. So you are asking the heart of our identification strategy. How are the listing codes determined? So as Chen just showed in the presentation, we have a plot of the listing code and the listing date. So basically, the listing codes are mainly determined by your listing board. So each listing board has a straight first digit denote your listing board. And then the next three digits are mainly determined by your listing date, but not related to other stock characteristics. So it's basically a first come, first assigned system. But we argue that there's very little room for firm to time the specific IPO date because there's a very lengthy progress in China. It typically takes more than 2 or 3 years from the day that you apply to the day that you finally get listed on the board. So it's really hard to time who will be your immediate neighbors on the listing code. And to your second question, so the display rank of the listing code is the default way of display for almost all the softwares. And whenever you open your trading platform, this is the way you see the stocks. Of course, you can choose to rank the stocks by some other rules that you choose to manipulate. But this would take additional efforts.
See, all right, thanks. Okay, any other questions?
Just a question. Just a very quick question. It's Carlo. Can you hear me?
Sure, please.
Yes. I look at that the presentation of that correlation of the returns across these different groups of stocks. Of course, that they kind of show a kind of monotonic pattern, although the difference of correlation is really not that big. I would say that. But one thing I wonder, instead of really looking at market adjusted returns, whether you do want to adjust for some other things like the industry, maybe you're able to tease out, right? More of this idiosyncratic information, and so that might even help you. To improve that kind of a pattern, rather than just based on this market adjusted return.
Totally. I think this is definitely something we can do. So in our main test, portfolio sorting and Fibonacci regression, we carefully control for all the effects we can think of. For instance, firm age, industry, and other stock characteristics. And totally, you're commenting on the co-movement results, and we can definitely do that. Thanks.
Yep. Thank you.
Okay. Thank you very much for Chen, Lian, and Zhenyu for the presentation.